Hello, it's the Smart Property Investment Show. Coming up in this episode, double toil and trouble, fire burn and property price bubble. It's flight path furore as we look at the impact of jet planes on property prices. And with Sydney having done its dash, we ask, where's next? All this and more in this episode of the Smart Property Investment Show. Hello and welcome to the Smart Property Investment Show, where we speculate, meditate and pontificate on all things property investment. My name is Andy Scott. I'm an investor and the publisher of Smart Property Investment. I'm joined as always by fellow investor and managing editor of the title, Mr. Phil Tarrant. Hello, Phil.
Hey, Andy.
How you going this week?
Really well, thanks. Good to be here.
Good. You sound quiet. You okay?
I'm all right, mate. I had a big Chinese dinner, so I'm a little bit slow at the moment.
Oh,
I'll pick up,
go.
Don't worry.
That'll do it, mate. That'll do it. Our special guest this week is the CEO of Positive Real Estate, Mr. Sam Saggers. Hello, Sam.
Andy, thanks for having me. Phil, always a pleasure.
Not at all, mate. Thanks for joining us today. How's your week been?
Mate, it's been pretty good, trying to keep the dream alive, so it's all happening.
That's good, mate. Look, Positive Real Estate, obviously you're coming up on your 10th anniversary, aren't you?
Well over a decade. Yeah, we've been punching away at it, so yeah, no, it's been going well, mate. So we're happy to celebrate a decade in the industry, helping people, helping investors.
Oh, congrats, mate. Look, for those that don't know specifically, what is it that you guys do?
Well, we do education, for one, so we help people understand what they can do financially. We work on property. We're deal makers. We look at the market. We analyse the market. We help people really free themselves financially to get ahead in this world.
And how many clients do you think you've worked with over the last sort of 10, 12 years?
In our club, we've got 6,500 members at the moment. So, yeah, fair few. Keeps you on your toes. So.
And it does. Well, you must be doing something right. I know you picked up a slew of the Investors' Choice Awards earlier this year, so congratulations on that, mate. However, look, people aren't here to listen to me, to ask you to tell us how great you are. Sorry about that. So without further ado, let's get cracking on with the first story. All about property bubbles, gentlemen. We are stuck in one. That's the reality. You're just going to have to face up to it. That's the opinion that's come from a major bank. They have labelled Melbourne's inner city apartment market as a bubble. They say it's being inflated by cashed-up foreign buyers. That was David Craig, the CBA Chief Financial Officer, making those comments. The NAB Residential Property Survey has just come out recently. Apparently in Victoria, 25% of new property transactions are from foreign buyers. We've had the Australian Securitisation Forum in Sydney the other week. We've had Fitch Ratings Managing Director Ben McCarthy. He said in the agency's view, and I quote, "Our view is we are in a bubble." So pretty cut and dry with that. Chris Joy as well. He is the Smart Money Investment Director, and he's a contributing editor to the AFR. He's basically said, I think there is a bubble. I don't think it's a massive concern. Sam, simple question. Is Australia in a property bubble?
I think certain pockets of Australia, absolutely, a little bit overpriced right now. There's going to be a correction. There's areas in Melbourne which are in a bubble, let's face it. There is a small bubble about to do a pop, and I don't think that's such a bad thing, to be honest with you. I think a correction in prices, particularly in Melbourne and Sydney, well, I think it'll bring some balance back to the market. And when we say bubble, it's an overinflated term. Does it mean your property's going to be worth half when the bubble actually pops? I don't think so. I think we're talking a correction of maybe 5 or 10%. I will add, boys, that Melbourne has some great areas to buy. In fact, if you actually understand the town plan of Melbourne, it's quite easy for investors to avoid areas of oversupply. In fact, if you have that concept in the back of your mind that you're a bit of a NIMBY, which stands for not in my backyard, well, you go to those suburbs and there's absolutely no supply, and they are very desirable areas. And I think into the future, areas like that, well, they just might grow in value.
What about you, Phil? Do you sit there and read these sort of... Because you were telling us you were looking to get or acquire a property quite soon in this market. Do you read these bubble stories and think, hang on a minute, I think I might sit my hands and do nothing? Or do you listen to people like Sam, who's in the industry, he wants to encourage people like you and I to invest anyway, saying it's all good, there's plenty of areas to invest. Get yourself going, get in there, ignore all the news. Where do you sit on things?
As a journalist, and I'm going to put the hat on rather than a property investor, I speak to people all the time, and one of the questions I ask, and I also get asked, is it a good time to invest? whether it's today, whether it's 6 months ago, whether it's 5 years ago. And my answer is always, yes, it's a good time to invest. It's always a good time to invest. There is always an opportunity in a market somewhere. So when I'm investing myself, I look at the numbers, I rationalise my investment as part of my overall strategy. Am I concerned about property bubbles? There's parts of the city market, there's parts of the Melbourne market where, are they overinflated? Yes, they are. Am I investing in those areas? No, I'm not. For me, it comes down to good old-fashioned research, grunt work, understanding what I'm trying to achieve and finding those locations that provide the best investment opportunity for me. So when it comes to property bubbles, we go through these cycles time and time again. Sometimes property's underpriced and it's a great opportunity. Other times it's overpriced and you silly get into property. It's always a good time to get into property. What I think's happened is that the APRA, our good friends at APRA, have identified that property is growing at a pace which is unsustainable. And I think that's where this bubble analogy comes from. And do I agree that property price increases in the city market is out of control? Yeah, it was. Already we're seeing, and you're probably better to chat about this, Sam, effects of the new APRA requirements in terms of investment lending, and it's really slowing stuff down. The auction rates are all-time low over the last probably 2-3 years. That's about right, isn't it? Yeah,
it's definitely had an impact. We probably saw roughly about 4 or 5 months ago those changes come through, and it was really quite dynamic how quickly the market started to actually cool. And really the APRA changes were geared towards Sydney. Let's face it, property prices have virtually doubled in 3 years, 4 years. So it's probably a good thing that it's coming in. At the end of the day, as a resident of Australia, I want affordable housing. I want people to be able to buy their dream home. And, well, you know what? Maybe it was pushed a little bit too far, so a mild correction. If people want to call that a bubble, well, in my world, it's just a mild correction, and that's what we're in store for.
All good stuff. So, look, I think the thing to take away really from that is that there are obviously going to be overheated places of the market, and as a serious investor, you probably want to steer well clear of that. But you know what? It's probably not the doom and gloom and the sky falling in that the headline grabbers and headline writers would want you to believe, I guess. Look, moving on. Just to look, our next story, I thought this was quite interesting. This comes from a study at the Queensland University of Technology. They looked at the impact of aircraft noise on home values. I know when I sort of first moved to Australia, where I was living at the time, I was under a flight path. It used to irritate me beyond belief. My gut reaction is, you know what? You wouldn't buy a place here. Who'd want to live here? And you'd think that would depress property values. They've done a study. Their conclusion is minimal, if any. Sam, it seems like a classic case of common sense just being wrong, basically. Living under a flight path is rubbish, so it won't be good. Not being supported by any data that's out there. Look, you obviously speak to a lot of novice investors, people who are trying to educate themselves. What are some of the most common misconceptions you think you hear that from your experience and the data that you see just do not hold up about property investment?
Obviously, if we're coming back to the flight path issue, I mean, one of my first jobs was in St. Peter's, which you feel like the plane's about to bloody bonk you on the head. It's that close. But if we look at that market, you would absolutely say that flight path issues have not affected that marketplace. It's grown extremely well in value. If I look at other areas where the aircraft noise is quite does impact suburbs, but I haven't seen it being relative to prices. I really haven't. We've seen places like Leichhardt, Hunters Hill here in Sydney where aircrafts pass by and it just doesn't affect it. In Brisbane, you got your Morningsides, your Balimbas where planes do land if they don't choose to land over the bay. And I just haven't seen that type of problem is causing impacts on prices.
What about yourself, Phil? You any? I suppose we refer to them as external factors, but any sort of things that either you hang your hat on and say, look, I look for that because I know it does affect property prices, or perhaps as importantly, things that you've learned to ignore. Like what we're talking. I mean, look, anecdotally, Sam said he realises it doesn't have any impact at all, but things that you've learned as well that as an investor I can pretty much get away with ignoring that.
Yeah, I think it depends on property cycles and also where within growth cycles certain suburbs are, and looking at Sam's analogy from, I guess if you draw a line from Hunters Hill to Mascot, you go over sort of the side of Balmain, Lilyfield, Leichhardt, and then into sort of your Erskineville, St Peters and all that sort of area. A lot of the suburbs surrounding those grew in value a lot faster than those directly under the flight path, but as populations and demand sort of increases, those suburbs become desirable because people are priced out in the neighbouring suburbs, which might not have as much plane noise. So eventually it just becomes irrelevant. And I think you find that's the case with a lot of investments where people would traditionally think, well, this is a bad or this is a negative attribute to it, and therefore I'm not going to invest in it, or this is such a bad attribute, if I invest in it I'm not going to get tenants in, that's a bad thing. But when you look at main roads these days, if I was 20 years younger and I had money to invest, I'd be looking at arterial belts around Sydney or Brisbane or Melbourne where I could be picking up land along main roads, which might not be desirable in terms of having a nice house on it, but when you look at zoning laws on these main arterial roads, they're getting high density stuff on it right now, and I imagine a lot of people are cashing in on that.
Well, we were talking about that off air before. The reality is some of the main road investments in Sydney have turned out to be real winners. I mean, we've heard stories of young families moving to North Ryde and buying on a main road, $800,000 a year later, being offered $1.8 million just because of the zoning law changes. So at the end of the day, I think, in dense populated areas where there's just more people than there is properties, at the end of the day, property always wins.
There is certain things, though, you need to be considering when you're investing, and this happened to a couple of mates of mine who have invested somewhere which presented a good opportunity, but when they get to the financing level, and you're much better to talk on this than I am, Sam, but they've bought a house which is near high tension power lines, and that sometimes influences the amount of money that a lender is willing to lend at a LVR.
Yeah, absolutely. If you're borrowing more than 80%, if you're going into 90%, particularly mortgage insurance is a real challenge. They'll look at the valuations of the property. They'll conduct their own analysis of the area. And if within the environment or local environment there is a challenge, it can actually affect your lending capacity. But more importantly, actually can affect the person who potentially you're selling to one day, their lending capacity, which really narrows the marketplace for resale. So you have to do your research, you have to do your due diligence. And a little tip for listeners, well, if you can get your hand on the valuation, you can always look and assess the risk rating on a valuation. And if it's greater than 3, and particularly in the environment sector, well, of course, you might just be not realising that you're buying something that has an impact or can have a local impact assessed to it.
So what's your, if you had to sort of pull out 4 or 5 red flags that environmentally you should be concerned about? You've got power lines close by,
Sure.
it being a flood-prone area,
bushfire,
bushfire-related stuff.
So you tend to, obviously every area is different. It can be things like too close to recycling, for example. So rubbish dumps can be a real challenge for lenders. Like you've identified, power lines. It can have things to do with the underneath the ground itself, where it's been some mining impact on it. It's a broad base. Lots of things can affect it. The tip for I'd say for investors is look through your valuations if you can get a hold of them.
Good stuff. Thanks, Sam. Now, coming up to what will be my favourite part of every episode. Phil, Sam, you may not know this about me, but I love a hotspot as much as, let's be honest, more than the next person. I literally can't get enough of them. There's a new report that's come out. This is the...
I think I've actually come to hate hotspots.
No, love them. Love them, Sam. Love them. This is the Hedonic Home Value Index. This is from CoreLogic RP Data. Tim Lawless making some things. And look, much as I love these things, I'm going to have to call Tim out on this. He basically... Look, this report has basically come out and said, look, Sydney and Melbourne's done. He then pretty much goes on to list every other place in Australia that's not Sydney and Melbourne. Phil, you've looked at some of this stuff. You can see some of the places that he mentions. Is there anything in this at all? He's talking about Southeast Queensland, Northern New South Wales, Tasmania, embattled Western Australia, Brisbane, Gold Coast, Sunshine Coast, Byron, Cairns. The list keeps Hobart, Darwin. The list keeps going. Is there anything in this, or is this just sort of confirming? Yeah, look, Sydney and Melbourne are done. Tim knows that people like us are desperate for hotspot stories, so he's just giving us what we want, even though he knows and we know there's nothing in it at all.
The thing is that, the guys over at CoreLogic RP Data, they got good research over there. They know what they're doing. They got some very, very bright cookies in there who can crunch some data and filter that over a whole bunch of different things. So anytime CoreLogic RP Data gives us something, I always consider it to be of quality. And, you're probably giving Tim a bit of a hard time here by sort of calling out that there's hotspots everywhere. I think...
I didn't quite say that, to be fair.
But, a lot of the places here they make a lot of sense to me. I think when it comes to hotspots, and I always say this, I don't want to sound like a broken record, but the hotspot we're talking about today was probably where you needed to be investing 2-3 years ago. So it's good to understand, I think, with hotspots, how someone gets to a point to be able to say that this is a hotspot. So what are the indicators that the person who said this is a hotspot has used to say this represents a good investment opportunity? And that involves a whole bunch of different things, wage growth, infrastructure, what the local government's doing, what the state governments are doing, what's the migration patterns, all these type of things, which are going to indicate whether or not a property is going to go up in value. And as property investors, that's what we want to happen. And also deliver good yields, and you want to get that from, the need for good work in the areas and the need to rent. So, I don't want to go down that path and that tangent, but, some of these areas, Southeast Queensland, yes, Northern New South Wales, I don't know enough about that to comment. I like going surfing up there, so I'd like a holiday house. Tasmania, well, I hear mixed reports about that when you look at fundamentals.
Good whiskey.
It's good whiskey. Very good whiskey. WA, we were chatting the other day about Perth and whether or not that's up and coming area. Well, when you look at mining investment and Perth essentially being linked to the resources, the fortunes of the resources sector, I'm not investing out there. I reckon you can get better returns elsewhere right now. But hotspots, yeah, we could talk about them all day.
What about yourself, Sam? You're always looking for the next area to sort of purchase positive real estate?
Yeah, sure. Look, obviously there's some fundamentals out there where it says macro-wise, maybe Brisbane's a good call, maybe Perth's at the bottom of the market. I mean, there's a lot of dark clouds in the sky in Perth. Maybe it is the best time to buy. I actually believe no matter what the market is, you can make money out of real estate. And, at the end of the day, the market itself, as long as it's a good capital city, people are going to wake up in 10, 15, 20 years and the property should have gone up in value, let's face it. But I actually believe right now we're looking at a time in the Australian market where potentially there isn't a wagon to jump on. Usually there's, always another new wagon or a new story that you can get behind. I actually believe right now the Australian property market's pretty flat. And what does that mean? Well, it's a race to quality. At the end of the day, there's been a lot of supply come into the Australian property market in all capital cities, but most of that supply, if you ask me, it's garbage. There's hasn't been, great buildings being built, good supply brought to the market, and if you can actually find the cream of the crop in all the suburbs out there, the best developments, the best new developments, the best property coming to market, well, you'll find that more people want that property. They become demand. And, good highlight for me, I've seen the Brisbane market sit flat for a few years now, but certain properties are going up in value. They are rising in value and really triggers why. And when you look at the why, it comes down to the sheer metrics of supply versus demand. There's just not enough supply of really good property coming into the market, but there is a lot of demand out there. And I think the oversupply of certain product coming to the market is creating this sort of macro noise that the markets will be quite flat. And it is quite true, they will. But if you can buy the right property, geez, you'll do well.
I think it's a really good point. And you probably see this a lot in the people you work with, and I know the sort of your business, Sam, is quite diverse. You do a whole bunch of different things. One of which is helping investors into the right property. when I speak to investors, whether I'm at a home buyer show and you said the same thing, Andy, they'll pick up a magazine or they'll look on the website, and the first thing they'll do is they'll go to the back of it or they'll go to the data page and they'll look up suburbs, and they typically start at the suburb that they grew up in, and they go, what's going on? What's the 3-year growth? What's the 3-month growth? What's the 1-year growth? What's the, et cetera, et cetera? What's the yield, time on market, and all this sort of stuff? And most people typically look to justify the reason to invest in a particular area by looking at the numbers to see whether or not it corroborates with what they think is a good idea. And I think that's completely back to front. And this sort of links into this whole hotspot stuff in that, how do you spot a hotspot? Well, you look at the numbers, what's going up the fastest in value, and that's where you should be investing. Well, that's completely the wrong way to be investing. Investing takes a lot more research, it takes a lot more understanding, takes a real rational look at what you're trying to achieve as a property investor and what your long-term game is. And do you think a lot of people, Sam, are misdirected in how they, without the education or before the education piece that guys like you deliver, and hopefully they get through smartpropertyinvestment.com.au, that it's all a bit about face and how they go about it?
Yeah, well, absolutely. I think if you ask the average investor getting started, do you have a strategy? What's your outcome? I mean, most people actually get floored when you ask them those simple lines. They don't really know. They know they should be investing, and then I guess the concept is, well, is there a wagon out there to jump on? And over the years, I've seen certain wagons come and go in this country. I've seen mining booms, I've seen tourism booms, I've seen certainly all sorts of dynamics. And unfortunately, a lot of people have jumped on those wagons based on, well, they sound great, the short-term viewpoint looks good, and now regretting a lot of those decisions. And I think it really comes back to, well, is it a premium location? Is it a premium product? Would an owner-occupier come in, get very emotional about this piece of real estate and pay you at auction a huge amount for the property? And if they won't do that, well, why are you buying it? Why are you buying it? So what I'm seeing in the market is we have seen a lot of supply come in, and back to probably our initial first story, it was about, well, is there too much oversupply coming into the market? Are there too many overseas investors buying? This kind of context. Well, there is a lot of supply being built for supply's sake. And my argument is, well, a lot of that product, it's just filling the gap, but it is not meeting the true demographic demand for, homeowners and owner-occupiers. If you can pick the right property for them, well, you're going to have a market to really sell to.
I just want to, something you just said then, which I really identified with, and you're not talking about property in an emotional sense, you're calling it a product. It sounds like, if I'm buying a managed fund, it's a product. If I'm buying some other investment, it's a product. So when you look at investment opportunities, for you, it's just a thing. It's not any emotional thing that you're connected with. And do you think is that something you encourage your clients to look at a property as well?
Absolutely. You have to. You have to remove emotion. As soon as you get emotional, you sort of ruin the idea of being an investor. And for me, I learned sort of early on in my investment career, after making some sizable mistakes, well, you know what, I need to remove emotions out of this and just really work off what's in front of me. And one thing that I like working from is really the town plan. Each city has a town plan, and it tells you where there's going to be too much supply, not enough demand. And then over and above that, really drill down in who's bringing the best quality products to market, and how does that affect the old established market and, of course, the new market in that area. And I'll tell you what, if you can buy the right property with the right architect, with the right design, the right features, the right home, the right lighting, right location, property looks after itself. Property is reliable. People are unreliable. People make the mistakes by buying the incorrect product. And it's all based on emotion. Yeah, getting stuff done, ticking that box, ticking it off the bucket list. People are in such a hurry. They just miss the core fundamentals. I know you guys do a lot of research through your publications, try and share as much as you can. And it's really important. People need to study for a bit, maybe grab a mentor, and get on with it properly.
I always say, I'm probably one of the most fortunate guys in real estate in Australia. In that, yes, I'm a property investor, but I'm a journo, so I can pick up the phone and speak to anyone. I can speak to you. I can speak to a raft of people who are top performing people in their respective fields, and that it gives me an advantage. It gives you an advantage, Andy. You can have those same conversations and pick people's minds. But anyone can do that, though. It's just a matter of identifying the type of people that can support you as you look to invest in property or look to grow your portfolio. And from that sort of perspective, before I go into another point about when you mentioned your own property investment story, who would you be corralling around yourself as a property investor to give you good advice or good counsel on developing a strategy and executing that strategy?
Well, positive real estate. No,
it's plug, Andy.
I think it's a fair.
You owe me money,
fair
Sam.
comment. It's important. Like most of us grow up in. I don't know about you guys, but geez, talking about money in my household was a bit taboo. Every time I raised the idea of going to make money, I think my old man was like, "Is he going to ask me for some? How do we avoid this?" So I think the average Australian grows up in a house which, the idea of getting out there and surrounding yourself with mentors or the idea of wealth, it's pretty foreign. By the time we get through high school or college we still don't have any financial management in our lives. So, I'd be getting a good property mentor, a strategist, maybe a financial planner. I'm a big believer in just creating a network around you and getting the job done. I mean, there's great accountants out there, great property managers. A lot of people have fear about just even owning real estate. So, you can buy anything in the marketplace and it will get you the result. You've just got to get out there and crack on.
It's good. So essentially it's okay to put your hand up and ask for help with this sort of stuff.
Oh, absolutely. I mean, I do it all the time. I'm an avid investor and I certainly don't know everything. And the main thing, though, I have access because I've built access around me. I've surrounded myself with great people to tell me when I'm in the wrong and also bring me good advice when I just don't know the answer.
So you mentioned that you're an avid investor, which is good to see that you're educating Australia on how to be better investors, and you're doing it yourself. What I'm interested in is something me and Andy always ask everyone that comes in on the show is to just get a bit inside their story and in property investment. And I'm not going to ask how many properties you have because it's probably rude, but I know you've got quite a few in your portfolio. Can you tell us a little bit about your first investment?
Yeah, sure. And I think, it's interesting. Does the number matter? Does size matter in property investing? It's something that people always sort of say, you got 10, you got 12, you got 20. Well, would 3 good ones be better than 20 bad ones? I don't know.
Oh, absolutely. I'd say, yeah, size doesn't matter.
Size doesn't matter.
I'm a big advocate of saying that.
As for me, where did I get started? Well, I'll tell you what, I got involved in real estate quite young. In fact, by the time I left school, my first job was really in real estate at age 18. I guess it was about 23, 24, 25. I bought my first property. I actually ended up buying it in an area I knew very well, in a suburb I grew up in. And for me, I bought based on emotion. I thought the property just looked so good. I didn't do any research into where the property market was at. I had this sort of fear of missing out. A few of my friends had bought, 2 years before, and I'd actually watched them make some money in the market. And so I wanted to do the same. So the logical thing for me was to buy in my own neighbourhood. I actually went door knocking to find my property. I didn't use an agent because I was a real estate agent myself. And I ended up getting hooked in. Probably the easiest person to sell to is another salesperson. So for me, I got quite emotional, caught up. And the first property I bought, well, it was in Putney, here in Sydney, which is a gun suburb these days. Certainly 15 years ago, I was buying at the time, property which was quite old. It was already 40 years old, and I ended up not having the best of time with that property. I bought it at the peak of a market, and I watched it lose a little bit of value, deflate, and I ended up selling the property and not making any money out of it. But I learned a hell of a lot. Actually, it made me ask a lot of questions about how do you do this right. For me, it was a great lesson. Great lesson. First property, best lesson I ever had.
So you say you didn't make any money off it. Is that like, you sold it for more than what you bought it for, but when you think about holding costs and all this
Absolutely,
sort of stuff.
yeah.
Yeah. And I think a lot of people get that wrong. They might hold a property for 2 years and sell it at $100,000 more than what they paid for it, and I think that they're an absolute genius. But then when they go back and calculate what the mortgage cost them and all the other
couple
stuff,
of gains, you name it, yeah.
It's a bit of a folly. But if I imagine you wish you still held that property now.
Well, it's an absolutely great sort of statement, and I should have. The reality is time in real estate is a beautiful thing, and if I had my time again, I would have held it. But I also value the lesson of buying that property, not really feeling comfortable with what I'd done and selling it, because it taught me some valuable lessons along the way of like, well, you know what, I need to look a bit deeper into the research behind what real estate is. And, I think it was a great lesson in a way. It's an expensive lesson.
Just out of interest, because you talk about obviously being an expensive lesson, you talk about you realise you pretty much stuff things up. How long did it take you from the moment you went, I've got to sell this and I've got out, to build the courage to go again? Because, it's once bitten, twice shy, right? You do something like that, especially with the amount of money that's involved. For a lot of people, you think that's enough. You hear a lot of property investors, ATO stat that gets rolled out a lot, only 85% of property investors own, or 85% only own one property. Yeah. And it makes me think there's a lot of, property investors, he says, doing air quotes, that have bought one and it's not necessarily gone well, or it's not gone up massively in value and huge yields, and they don't necessarily sell it like you did, but it also stops them trying again and doing more. How long did it take you, and what did you get over, or did you just not care?
It's a good question. I mean, back then I'd saved everything I had to buy that property, so a small amount of money when I look back on it now, but a big amount of money at the time when you're sort of 23, 24, I saved $40,000 and put it into the market. And really, I gave that money to the real estate market, because I don't look at it like I necessarily lost it. I actually didn't do my research, so I passed that gain on to someone else. Someone else came and bought my property, and that money disappeared. So for me, I had a choice at that time of my life whether to, not be involved in real estate or start again. And I just put together a real good savings plan, and within sort of 2 years of that first problem, I was ready to go again. And that time I started to do it right.
So you hear a lot when people make, I would say your first investment wasn't an absolute, disgrace.
I wouldn't call
of
it a train wreck.
It's not a train wreck. But you hear a lot of people that actually their first investment is a train wreck, and it ruins them for 10 years. They overpay for a property, then they need to sit around and wait for the market to catch up to where it is and go over it before they can do something else. And it's a massive problem. What is the one train wreck that you've made though? Tell us about the worst, the biggest mistake you've made in property.
I think for me, probably the idea of chasing the cash flow dream. And there was a while there where yields were all the flavour, and of course we to follow a good yield, to get a high return, 10, 11%, sometimes you have to take more risk. And it was the first time for me taking risk. I was pushing out to regional areas in Australia, and really I've seen those returns really decline. And probably the one that stands out, I bought a property 15 years ago in Moree. It's worth about 120 grand at the time I bought it, and it's probably still worth about 120 grand. It's done absolutely nothing. It's just been stuck in this limbo land for a very, very long time. Of course, the idea, the principle behind that real estate was, we'll chase the yield, get a high return. And still to this day, I get a 10% return, which equates, after all my outgoings and strata fees and this, that, the other, I get about $10 a week, which doesn't make you wealthy. And if I had my time again, I probably wouldn't have bought that property, because to be blunt, there's not too many buyers in the market for that type of property. The only people who would be buying it would be probably unskilled investors at this point in time. I don't need to sell it, so I just hold on to it. But it hasn't been a great experience. If I was to take that money and put it into a better performing vehicle, I'd probably be steering my money towards good capital city rather than rushing off for the cash flow dream.
Sam, appreciate you sort of sharing that story with us and just giving insight to what you've done. Obviously, look, you built a very successful company. You dealt with a lot of properties, and I think it just goes to show, even with a few missteps early doors, if you put yourself a strategy and a plan in place, there is a way that you can still move yourself to where you hope your wealth creation dreams go with property and all of that. That's pretty much all we've got time for this week. Sam, thanks for coming in again. Remember, you can come and visit us at www.smartpropertyinvestment.com.au. You will find all the stories that we've been talking about today, plus the ones we'll be talking about next week, and of course a whole lot more information on there that's good for all smart property investments to check out. If you've liked what you've heard today, please don't hesitate to leave some reviews for us and rate us and give us 5 stars and all that good love. Obviously, if there's anything that you want to hear more of, or probably as importantly you want to hear less of, unless it's me, you can contact us or rather contact me at publisher@smartpropertyinvestment.com.au. That's all we have this week. Until next time, Sam, please say goodbye.
Thank you very much, listeners, and thanks, fellas.
Phil, say goodbye.
See you later, Andy. See you, Sam. Thanks for coming, mate.
And this is me saying goodbye. See you soon, guys.